please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Well, on to some macro data now. The retail inflation has cooled off in the month of March, coming in at 4.28% on the back of a dip in vegetable and other food prices. Lata joins in to take us through the CPI data. Lata.
Well, it is a mixed set of data. The fact that it's come in at 4.28 is better than what the Reserve Bank had prepared us earlier in the year, probably 5.1. They recently scaled it down to 4.5. This number is even lower than that. So to that extent, it shouldn't be treated as bad news. But the irksome part is that the market was expecting 4.2. So 4.28 will be a bit of a jar. More importantly, the contents. While food inflation has definitely come down, it's all of 2.8% compared to 3.2% even last month, that is February. What's worrisome is the non-food, non-fuel inflation. That's called core inflation. Largely refers to services, which is the steady part of the CPI basket. That's grown by 5.37% compared to 5.17% in the month of February. So you could crib a little, but overall, the inflation sentiment will be determined more by where crude prices head. So this perhaps will be an hour's dismay for the market, won't be a very troublesome number to swallow.
Well, Lata, the index of industrial production also maintains its momentum, coming at around, 7.1% for February, making it the third straight month that the number has been above the 7% mark. What do you make of these numbers? 3 straight months above 7%?
Absolutely. I mean, that's where the hope is. Growth is definitely ticking higher. Actually, the turnaround has come almost since the month of August. We have seen the month-on-month inflation number, month-on-month industrial output number improving. And the last 3 numbers have been particularly good with a 7% growth. We must remember that they had the advantage of a low base as well, especially December and January. They were demonetization months, year-ago base. But by the time we come to February, things had picked up a bit. Even then, 7% is a happy number. The very poor base, of course, was is an additional support. But the internals of the industrial output number give you some cause for greater joy. The capital goods number has come in at 20%. And I think it's the 3rd or 4th month that we have seen double-digit growth. I think from November, we are seeing double-digit growth in capital goods. That's a little heartening. Again, a low base, but still, nevertheless, that's heartening. As well as consumption goods, both consumer durables and non-durables have come around 7.5% each. Both those are encouraging numbers. The only thing is, if you looked at the April-February number, that is the year-to-date number, then the industrial growth number is only 4.3%. So it's just the last 3 months that look very good because of the base. That's, calling the glass half empty.
Okay, all right, Lata. Thanks very much for that. Time for a break now. Up next, we'll get you key expectations from Infosys on the other side.
Welcome back. You're watching Power Breakfast on CNBC TV18. Now, in today's trading session, Infosys, that's going to be in focus. Remember, earnings season kickstarts with that IT major. It's going to be reporting its numbers today. Let's get in Rima Tendulkar. She'll give us all those expectations. Rima.
Yes, going into its earnings quite strong on account of the recent appreciation, but the sector per se has been an outperformer on expectations of a pickup in global growth, a portfolio shift away from banks to IT, as well as the underweight positioning of large investors in the sector, which got corrected. So Infosys per se has rallied close to about 10% on a YTD basis. The March quarter expectations on the top line, that's dollar revenue growth, is seen higher by 2% sequentially. Now, Q4 is a seasonally weak quarter, but this quarter will look better on a year-on-year basis, largely on account of the cross-currency tailwinds. On a constant currency basis, we are expecting a growth of about 0.8 to 1%, which would compare with no growth in March of 2017. EBIT margins will be flat at 24.3% on a quarter-on-quarter basis. Optically, the profits will look lower sequentially, but that's because the prior quarter, that's Q3, had a reversal of an income tax provision. If you strip that out, then profits would also be on the flatter side. Now, with these numbers, the company is on track to achieve its FY18 guidance. So in constant currency, revenue should be close to about 6%. The margins should be within the company's guided band of 23 to 25%. But the key to watch, as always, will be their FY19 guidance. This will be the first guidance, coming in from the new CEO, Mr. Salil Parekh. The street is working with a constant currency guidance of 6 to 8%. Some believe it could be a little more conservative and come in at 5.5 to 7.5%. But if it is 6 to 8%, that means at the lower end, growth will be similar to what they saw in FY18, and at the upper end, which is 7.5 to 8%, there is an acceleration in growth. We'll see how conservative the new CEO gets. The other thing to watch will be the heightened management attrition that has come through on account of the management churn, the initial strategy of Mr. Salil Parekh on the capital allocation, his strategy. There will be an analyst day on the 23rd of April, so we'll get more color on that. And also sectorally on BFS, that's banking and financial services, where Infosys has sounded more confident and optimistic compared to its rival TCS.
Okay, all right, Reema, thanks very much for that. Well, some management changes at the FMCG major, HUL. Harish Manwani will retire as the non-executive chairman after spending more than 40 years at the company. Sanjeev Mehta, the present MD and CEO, will take over as the chairman and MD following the annual general meeting in June this year. Sanjeev Mehta has also been given another 5-year term as the MD and CEO. All appointments are subject to shareholder approval in the upcoming annual general meeting.
All right, then OMCs, they have been in focus in the last few days. Remember, crude prices have hit the highest levels we have seen in the last 3 years, in fact. CNBC TV18's Anshu Sharma caught up with Oil Minister Dharmendra Pradhan on the concerns it raises for Indian consumers. Let's listen in.
Certainly, when in international arena market price go up, it concerns India's policy maker because it pinches our consumer. That is the reason, very candidly, Prime Minister appealed to the world energy producer. Yes, we don't want a very low oil price, but it must be responsible. Why there will be such a price hike? What is the reason? Financial market, sentiment, all these are fine. But ultimately, affordability of common consumer is an important issue in Indian policy, public policy. That is the concern we have, and very categorically, Prime Minister rightly emphasized that issue yesterday.
OMCs have ruled out that government has asked them to absorb 1 rupee per litre on petrol and diesel, and the government has ruled out any excise duty cut. So how is government going to reduce the burden on consumers considering the petrol and diesel prices are going high?
Let us see, wait and watch, because we never interfere the day-to-day pricing mechanism of companies. This government consciously to looking into the long-term interest of the consumer of this country. If we continuously control our pricing mechanism, no new investment, no players will come to in the retail marketing. Unless until more players will come to retail marketing, there will not be fair competition among themselves. On that principle, we never interfere in the day-to-day price mechanism of companies. It's up to them. Yes, as I said, high price is a challenge. Government is watching the scenario. Let's see.
Is there any room for excise cut?
I am not in speculation business.
Well, the 15th Finance Commission has become a steamy affair with the southern states on a warpath. The most contentious issue is on terms of reference of the Commission that states that the devolution of funds be made on the basis of the 2011 census. The southern states, barring Tamil Nadu, are irked because the total share of the southern states in the country's population has fallen from 22% in 1971 to 18% by 2011. Prime Minister Modi has specifically defended the terms of reference, saying that the government has asked the Commission to incentivize states that have worked to control population.
A baseless allegation is being made about the terms of reference of the 15th Finance Commission. The Indian government has suggested to the Finance Commission to consider insensitivizing states who have worked on population control. By this yardstick, a state like Tamil Nadu, which has devoted a lot of effort, energy and resources towards population control, would certainly benefit.
Well, we spoke to Abhijit Sen, the member of the 14th Finance Commission, and Thomas Isaac, Finance Minister of Kerala, to discuss the divide over the terms of reference used by the 15th Finance Commission. Here's what they said.
TORs of finance commissions in the past have really been very neutral. It's not the center telling the finance commission, you look at this from our point of view. It's those matters the center can raise with a finance commission in a memorandum, just as states can do.
Okay.
But the TOR should be above both the center and the state and treat them, in an equal way.
Okay.
Again, the point is what happens. Is it 91%, this percent, that percent?
Okay.
Is to the discretion of the Finance Commission.
Oh.
And that is true also of the Prime Minister saying that they will look at the incentive. Come along. I mean, the Finance Commission is a constitutional body. The constitutional gives it.
Okay.
The present terms of reference go beyond past terms of reference in trying to push the Finance Commission into doing a particular thing.
91% of the total award of the Finance Commission is on the basis of tax devolution.
Okay.
And the entire this 91% is based upon 2011 population.
Okay.
While the incentives that the PM is speaking about are 9 in number, and at most the allocation would be, say, 2 to 3% of the total award of the Finance Commission.
Okay.
If you go by the earlier awards.
Okay.
And therefore, it can never, even in the distant dream, compensate for the loss that is made in the tax devolution.
Okay, all right. Well, moving on, the Bank Board Bureau, led by the former Comptroller and Auditor General Vinod Rai, has been recast. The 4-member body was formed in 2016 to improve the performance of public sector banks. The new chairman will be Bhanu Pratap Sharma. He was a former secretary at the Department of Personnel and Training. The 3 members in the committee will be Vedika Bhandarkar, who was a former executive at Credit Suisse India, Pradeep Kumar, a former managing director at State Bank of India, and Pradeep Shah, the founder and managing director of rating agency CRISIL.
All right, then, and we spoke to Financial Services Secretary Rajiv Kumar and Pradeep Shah, one of the bank's board's bureau's newly appointed members. Let's listen in to what they had to tell us.
The selection away from the government, in which government doesn't have a say. It's only the expert body, which is BVB, does it. So this is in continuation of that, and it's a renewed commitment. And it has generally been in the entire HR space of the government of India that no interference is there in from the government side, and it's essentially the merit in the entire landscape of the HR. The banking board bureaus, all recommendations essentially earlier also related to the HR related things. And the last BVB mandate also gives them a mandate of suggesting on the capital side of the banking. So that within the mandate, as is the existing mandate of the BVB, this will be working.
There are brilliant people in the public sector banks, and now the attempt has to be to get them to perform and give the results that. And avoid the results that we've seen in some of the public sector banks. Too short a tenure does not do justice to that person nor to the bank. So I think I would prefer 5 years is, of course, better than the 2 years and 3 years that we have seen in the past.
All right. Well, 3 years after SEBI has directed cancellation of Sahara's mutual fund registration certificate, it has now asked the company to wind up all its schemes. Yash Jain is here with all of the details. Yash, over to you.
Well, certainly a long pending order from the market regulator. SEBI has directed Sahara Mutual Fund to wind up all its schemes by April 21st, 2018. There's of course a little bit of exception with just one scheme, which is called Sahara Tax Gain Fund, which can also be only operational till July 27th and will also have to be wound up within a month thereafter. Remember, this case dates back to 2015 when, due to regulatory action against Sahara Group, SEBI had directed the cancellation of registration license of Sahara Mutual Fund, saying that the promoters of the company are not fit and proper to run the mutual fund business. This order was of course then going forward challenged by the company before the Securities Appellate Tribunal, which then disposed of the matter, giving the company 6 weeks to appeal before the Supreme Court. Going forward, the Apex Court had also upheld market regulator SEBI's directive, and it's a result of that legal victory that SEBI has reinforced its decision and its directive to ask Sahara Mutual Fund to bring an end to its mutual fund operations.
Well, let's do a quick check on the Asian markets and let's see how the Shanghai market and Hang Seng actually have opened up. You've been getting those rates in the last few minutes. Well, it's green on the screen. The Hang Seng, in fact, has opened up with a gain of close to around 100 points. So good news there. But the Nikkei, I think we should pull up the intraday chart of the Nikkei. That will be quite important. When we started off the show, it was trading with a gain of around 250 points. The intraday chart will tell you that, in fact, the Nikkei has come off close to around 120 points from the high point of the day. So very quickly, that should come up for you. There we have it, the intraday chart. So the Japanese market off the high point of the day, but the SGX Nifty was indicating that we're likely to start off in the green. And I think last I checked as well, it was indicating roughly around a 30-point uptick. Now it's indicating a 22-point uptick. So green on the screen to kickstart trade. Let's see where we go from there. But on that note, let's get in some opinion coming in from Kenneth Rogoff, professor at Harvard University, as well as Victor Switch of Macquarie, on what they make of global growth as well as the Fed rate trajectory.
Okay, well, let's get Manisha in now. She's going to give us an update on what's happening in the commodity space. She's looking at metals this morning. Manisha?
Well, morning, yes. There has been so much volatility in that space, and we have been watching out for the overall global cues and the individual fundamentals as well. And then there are import tariffs and geopolitical concerns and sanctions on Russia and proposed on Iran. So there is plenty happening which is impacting the metals as a space. Yesterday was a day of profit taking, and we have started slow in Asia today as well. So if you look at the zinc prices, they are still holding around 4-month lows. If you look at the steel construction demand in China, that has picked up on a very slow pace, and that really has pulled down all the steel ingredients with it. We have been talking to a lot of global experts as well, and the estimate really is that even with the kind of concerns that we are and with the kind of weak demand that we're looking at, you perhaps are looking at yet another 3 to 5% of a decline in case of the metal prices in the very near term. And that perhaps would be a level where you would see an opportunity buying and accumulation happening at lower levels. At these kind of levels, there isn't really so much of support coming in.
Okay, all right. Thanks so much for that, Manisha. Well, Mangalam joins us yet again to tell us about the derivatives market. Mangalam.
Good morning, Nigel. Looking very good as far as the derivatives markets are concerned, primarily because of the 3 days in a row that we're seeing purchase in index futures from the FIIs. So if you take a look at the last 3 days, 1,100 crores, 620 crores and 315 crores on the buying side in index futures. What this means is that just in the last 3 sessions, the FIIs, they've added close to 27,000 net long positions. They've added close to 13,500 long contracts in index futures, covered 13,560 short contracts in index futures. So at CD start, while they were 18% long, now they're 26% long. Going forward, it may perhaps cause some more short covering if we sustain at higher levels. What was a positive is that the open interest range, that's moved higher from 10,000, 10,500 to 10,300 and 10,600 on the upside. Yesterday, the puts saw a lot of writing. 10,400 puts added close to around 13 lakh shares on the short side, as did the 10,300. But what I was most enthused about is the fact that the call writers, they ran for cover, felt a little jittery, and these were the calls which are currently in the money. So 10,500, the call writers, they're in the money. 10,500 call, for instance, that one shed about 6 lakh shares in open interest for a premium of 81 rupees. So there is some fear of the upside. In terms of stocks, watch out for a couple of these stocks which saw short covering yesterday. Dish TV was the one. Infosys ahead of results today, and the IT up move saw some shorts running for cover. Talking about the IT stocks, a lot of long positions added on both TCS and TechM, and finally shorts added on SAIL and Adani Enterprises, which underperformed in trade yesterday.
Okay, all right, Mangalam, thanks so much for that. Well, on that note, we'll wrap up on Power Breakfast. You stay with us. Bazaar Morning Call comes up next.